Welcome, and thanks for joining us. In today's case study, Tom and I will discuss donating an insurance policy to a charity as an alternative to donating cash or securities. We will also look at how this might affect a person's tax situation.
Rachel and I run a portfolio management business at Raymond James in Calgary, Alberta. Rachel's been in the financial services industry since 2012, and I've been advising clients since 1997. Our clients appreciate that we bring value-added ideas in addition to traditional money management. Today's value-added idea? Using an insurance policy to donate to charity.
In this video, we look at the critical decisions involved when donating a life insurance policy to a charity. When donating, people need to consider the type of asset that they want to donate. This might be assets such as cash, securities, but if you're considering a life insurance policy, there's other math that needs to be considered. Tom and I run that math for people who are looking at what to donate and how much. Let me introduce Laurel. Laurel is 60 years old, lives in Alberta, is happily married. She had a successful business owning a flower shop for several decades. She has recently sold, and the good news is, well, now she has a tax problem. Laurel knew that it was now time to donate to her favorite charity, as this would help her tax problem and also provide funds to her favorite charity, so it would be a win-win. She also wanted to consider establishing her legacy. Her and her husband both cared very much about arts and education in Alberta.
Laurel had a universal life policy with a death benefit of $250,000. She bought that originally as an income replacement tool for the benefit of her husband in the event that she died early. Now, she's comfortable that their financial future is sound, secure. So she doesn't need the policy anymore. She doesn't want to pay the premiums anymore. She does want to help a charity. So she's got three choices. Choice number one, she redeems the policy for its cash surrender value, which at the time was roughly $100,000. She could take that $100,000, donate it to the charity, receive a tax credit of $50,000. Sounds pretty good. The charity gets money today, she gets a tax credit today, but Laurel compared that $100,000 cash surrender value to the much larger $250,000 death benefit and thought she might be leaving something on the table. So she looked at alternative number two. She could have kept the policy alive by continuing to pay the premiums, but naming the charity as the beneficiary. When she died, the charity would get the $250,000 and her estate would get the tax credit at that time. But that didn't help Laurel's current tax problem. So she looked at number three. Choice number three had Laurel donating the entire policy to the charity today. And charity gets $250,000 when Laurel dies. Laurel gets a tax credit today, win-win. In fact, Laurel got 2 tax credits. So when she donated the policy, the fair market value on that policy was $100,000. So that $100,000 donation equals a tax credit of roughly $50,000. Tax credit number one. She takes that $50,000 and buys an annuity and immediately donates it to the charity. Tax credit number two. With that annuity, the charity now has an income stream of $2,300 per year. They apply that $2,300 on the premiums of the insurance policy to keep that policy alive until Laurel dies. So what you have here is a charity benefiting by $250,000 when Laurel dies. Laurel benefits with the tax credits today. That turned out to be a really good solution for her.
If you're thinking about making a donation and want to have a conversation about how much to donate and what asset to donate, you're encouraged to contact us.
We'll run the math for you. And with our analysis, you can have a more productive conversation with your tax professional, and you can make a better decision.
Please call us to find out how we can help you today.